There are three types of main stock indicators. Valuation indicators that help to compare how undervalued or overvalued a company is to other companies. Profitability indicators that show how effective a company is, and solvency indicators that show how risky a company is. Valuation indicators. The first and most popular indicator for companies' valuation is the price-to-earnings ratio. This can be calculated for a company separately and for indexes as a whole. Market capitalization is divided by the company's annual net profit. This indicator can be very distorted by companies' unusual one-time losses or gains. Also, if one company has a price-earnings ratio of 20 and another from the same sector has 10, what if the first company has a better growing dynamic? Which company would be more undervalued then? Well, for this there is another indicator, a PEG ratio, price-to-earnings ratio divided by annual EPS growth. EPS means earnings per share, net profit divided by total number of shares. Another popular indicator, PS or price to sales. Capitalization is divided by revenue. The problem here is that companies have very different net profit margins. If one company, for example, has $10 billion revenue and net profit of $3 billion, while another one from the same sector has $10 billion and $1 billion net profit, they would have the same price to sales ratio if their capitalization is equal. The next popular indicator, PB or price to book ratio. Capitalization is divided by the cost of company's assets. If they cost less than the capitalization and there is nothing fundamentally wrong with the company, then it's undervalued. PC or price to cash ratio. Capitalization is divided by the cash company owns. Very simple. The next indicator, PCF or price to cash flow ratio. Market capitalization is divided by operating cash flow, the amount of cash a company is created by normal business activity. This is a better indicator than the price-earnings ratio because it helps to eliminate accounting anomalies. If we also subtract capital expenditures from operating cash flow, we can calculate the last valuation indicator, which is PFCF or price to free cash flow ratio. Free cash flow represents the available cash flow to fund non-asset related growth, which is basically the company's ability to generate bigger revenues. These were valuation indicators. The lower they are, the better, unless they are negative. The next group of stock indicators is profitability indicators. Return on equity, net income divided by shareholders' equity, which is the difference between total assets and total liabilities. This indicator represents how effective a company is using investors' capital. If the capital is very big and net income is very low, the company is not using the capital effectively and the return on equity is low. A historical trend of a steady, strong return on equity can be a durable competitive advantage. However, the company can have a big debt and it can distort this indicator, and in this case, it's better to use return on assets, net income divided by total assets. It is a similar indicator that just doesn't exclude liabilities from the calculation. It also shows the efficiency of the company's business. Another profitability indicator is return on investment that helps to evaluate how well an investment has performed. The return of an investment is divided by the cost of the investment. This indicator simply helps to calculate profit from the investment. EBITDA, or earnings before interest, taxes and amortization. If you would divide EBITDA by revenue, you will get another indicator, EBITDA Margin. That is another profitability indicator. And the net profit margin is a similar indicator that excludes interest and taxes from the calculation. These were profitability indicators. The higher they are, the better. The next indicators are solvency indicators that represent the risks. The first is DE or debt to equity ratio. Total liabilities divided by total shareholders' equity. The higher this ratio, the higher a company's financial leverage and the higher risks of the business. Total liabilities include both long-term and short-term debts that have different risks. This is why there is another indicator, long-term debt to equity. Long-term debt is money that the company owns but doesn't need to repay within the next 12 months. If a company is very profitable, high debt can increase earnings if the debt's interest is low. And there is another indicator called interest coverage ratio. Interest coverage ratio that shows how easily a company can pay interest on this outstanding debt. The higher the coverage ratio, the better. These were all most important stock indicators for investors. Thank you for watching.